So let me review the topic we covered last time. This is our second lesson on this topic. So for some of you are not there last time, so let me review the topic very fast before we do a question. We said, don't write. We said, if you want to know whether an asset has suffered an impairment loss or not, we said as a company, you compare what we were calling the carrying amount of that asset with an amount we were calling the recoverable amount of that asset. And we said an asset is said to have suffered an impairment loss. An asset is said to have suffered an impairment loss if the carrying amount of the asset is higher. If the carrying amount of the asset is higher than its recoverable amount. That is the only condition under which an asset suffers an impairment loss. Only if the carrying amount of the asset is higher than its recoverable amount. And so we are assuming, suppose an asset has a carrying amount in your books. Your asset has a carrying amount of 1 million. Then we said, suppose you as a company, you calculate the recoverable amount of that asset and you find it is 800,000. We said, if the carrying amount is higher than the recoverable, then it has suffered. So from this illustration, this asset we saw, it had suffered an impairment loss of how much? 200,000. That 200,000 we said should be written off against the profit in the profit and loss account. So how do you write it off? We said you go credit the asset to reduce the asset from 1 million to 800. Remember, the true value of this asset is 800, but it appears in your books at 1 million. But the true value of that asset is 800. So we should reduce in value that asset. We reduce the value of that asset by the amount of the impairment loss. So we said you credit the asset by that 200,000 and we said you debit P&L account. Then from there, I developed the example further and I told you, suppose you have another asset, you as a company, and we are calling it asset B. And that asset B, by the beginning of the year, it had a book value of 100 million. Then during the year as a company, you revalued it by an extra 20 million. Whenever you revalue an asset, we said the normal double entry is you debit the asset and you normally credit this account we are calling revaluation reserve. Whenever you revalue an asset upwards, you normally debit asset and credit revaluation reserve. So we said, after you revalued this asset, from now onward, it will not have a carrying amount of 100 million. It will have a carrying amount of 120 million. 120 million. That's what we said. And then, suppose something during the year happened, and you as a company, you think, maybe that which took place during the year could have made our asset to suffer. So you wanted to test whether it has suffered an impairment loss. So what did you do? You computed the recoverable amount of that asset and you got it as some assuming 90. We were assuming something like 90. So we were saying, now the asset had a carrying amount of 120. By the end of the year, it has a recoverable amount of 90. Has it suffered an impairment loss? We said yes. By how much? By this 30, by that 30. Then I asked you, that 30 being the impairment loss, do you write it off? Do you write off the 30 million the same way I wrote off the 200,000 up there? We saw the answer is no. We said no. You don't write off the 30 in the same way. And we said this, when an asset which has been revalued, suffers an impairment loss, then that impairment loss, which in our case here is 30, we said that impairment loss should first be considered as a revaluation decrease. In other words, I said, you cannot say that your asset has a revaluation gain and at the same time it has suffered. No. So the first thing you do is to eliminate that revaluation reserve. You cannot continue keeping the revaluation reserve for that asset if it has already suffered an impairment loss. So we say write off first the revaluation reserve. So out of the 30, we had to write off the revaluation reserve of how much? 20. Remember, your reserve account had a balance of 20 for that asset, had a revaluation balance of 20. So we said this 30 should first be considered as a revaluation decrease. And to that extent, we said you now debit the revaluation reserve to write off, you debit the revaluation reserve, and you credit the asset by 20. But the impairment loss was not 20, the impairment loss was 30. We went further and said any excess of the impairment loss, it's the one now you write off against the profit in the profit and loss account. Like in this case, we saw there was an excess of 10 million balance of the impairment loss. So that 10 million is the one we said you write it off against the profit in the profit and loss account by crediting the asset. Of course, the asset has to be reduced in value. You credit the asset and you debit the P&L account. Good. Then from there, we asked ourselves, we have been saying, compare the carrying amount of an asset with its recoverable amount. So we were asking ourselves first, what is the carrying amount of an asset? And we defined the carrying amount of an asset as the amount that is considered, the carrying amount of an asset is the amount at which the asset appears in the books after deducting, of course, the accumulated depreciation. That's the same as saying it is your net book value. So that's all we can say about the carrying amount. But then we asked ourselves, how do you determine the the recoverable amount of an asset? How do you determine the recoverable amount of an asset? And we say, to get the recoverable amount of an asset, you have to calculate two values for the same asset. You have to calculate two values for that one asset, whether it's machinery, whether it's motor vehicle, whether it's furniture, and so on. Number one value you have to calculate for that asset is what we are calling the net realizable value. The value we are calling here, the net realizable value here. This net realizable value, that is what we said is one of the figures you have to calculate. The second figure you have to calculate for that particular asset is what we are calling, number 2 here, is what we are calling the value in use. The value in use. Once you compute the two values of that asset, we said whichever of the two is higher, that is what you consider to be the recoverable amount. So we defined, and I told you it's important to keep remembering the definition of recoverable, because we said most questions will ask you to define what is a recoverable amount. We said recoverable amount of an asset is the amount that is considered to be the higher of, number 1, the net realizable value of that asset, and number 2, value in use, whichever of the two is higher. After we discussed that, we asked ourselves, but then how do you calculate the net realizable value of an asset? How do you calculate the net realizable value of an asset? And we said, to get the net realizable value of an asset, here we saw, you take the selling price of that asset. To get the net realizable value of the asset, you take the selling price, which we were also saying it is known as the fair value or the market value. Take the selling price of the asset, and we said you minus any cost to sell, and you minus any cost to sell. Once you take the selling price of the asset and you minus any cost to sell, then whatever you remain with, that becomes the net realizable value. I also told you some books call this value fair value less cost to sell. Instead of calling it net realizable value, some books will call it fair value less cost to sell. It's the same. The second amount you have to calculate is what you are calling the value in use. Then I took you through on how do you compute what you are calling the value in use. And I said, I can see it here. We were assuming, suppose as a company, you are testing for impairment of your asset as at 31st December 2024. I can see it there. So if you are testing for impairment as at 31st December 2024, we said you will have to ask yourself, as we shall be continuing using this asset in the future, whether it's machinery, motor vehicle, what are the estimated future cash flows that will be generated from the continuous use of the asset? What are the cash flows that are expected to be generated from the continuous use of the asset? Once as a company you estimate those future cash flows, that 1 year from now, 2 years from now, 3 years from now, these are the cash flows we're expecting to generate from this asset. Once you identify those expected future cash flows, we said, get the present value of all those future cash flows. Get the present value of all those future cash flows. And we said, once you get the present value of the future estimated cash flows, that will give you what we were calling the value in use. And so we were defining value in use because it's another term you're told to define most times. You're told to define what is value in use. So we are saying value in use is the present value of all the estimated future cash flows that will be generated from the continuous use of an asset. It's the present value of all the estimated future cash flows that will be generated from the continuous use of the asset. Good. Then I took you through and I told you, how do you determine which cash flows are these? Which future cash flows are these that the accounting standard requires should be discounted in the determination of the value in use? And we saw there were 3 components of the cash flows that should be discounted in the determination of the value in use. One, we saw one of the cash flows that you have to determine is any cash inflow that will be generated 1 year from now, 2 years from now. What are the cash flows that we expect to generate, cash inflows that we expect to come in from the continuous use of that asset? That's one of the components. Number 2, I said another component of the cash flow that should be discounted according to the accounting standard is any cash outflow that is necessarily incurred in order to help the company to generate more cash inflow from the use of that asset. I gave an illustration and said, suppose you have a machine and 5 years from now, 6 years from now, as a company you are projecting that you shall spend maybe 100,000, you will spend 100,000 for maintenance of that machine. It is of course necessary that you spend for maintenance so that you use that machine to help you to generate more cash inflow, because if it breaks down, you may not generate cash inflows in the future. So you may be required to incur some maintenance costs in a particular year in future. Maybe you normally maintain or you normally repair or keep the maintenance of that asset maybe after every 2 years or 5 years, whatever. But the point is that you as a company are going to incur some cash outflow, but that cash flow you're incurring or spending is necessary so that it helps you to generate more cash inflow from the use of that asset. That was number 2, that any cash outflow which is necessarily incurred in order to help to generate more cash inflow. Number 3, the third component of the cash flow that I told you should be discounted is any cash that is received or paid at the end of the useful life of that asset due to the disposal of the asset. I told you at the end of the useful life of an asset, normally that asset has to be disposed. In most cases, you will sell that asset and therefore you will receive cash. But other times, I told you, you as a company you may be required to spend some money whenever you are disposing an asset. Maybe you are the one incurring that cost of disposing the asset. I gave you an illustration. Suppose you have an asset which has to be dismantled. For you to dispose it, it has to be dismantled. And for it to be dismantled, you have to incur some cost. So which means at the end of the useful life of that asset, we as a company, we are not the one receiving cash. Instead, we are the one incurring or spending cash. So at the end of the useful life, it is either you will receive cash or you are the one going to pay cash. But I've told you in most cases, you receive cash. Good. So those are the 3 components that should be discounted in the determination of the value in use. I told you it's important to remember them because some questions don't give you the all the cash flows. They don't give you the actual cash flows. No, they give you some inflows, and maybe one of them, there's additional information, they give you maybe a cash received at the end of the useful life. Good. Then from there, I took you through an example here. Just to see whether you can tell whether an asset has suffered an impairment loss. And I gave you a question and you answered me correctly, whereby I can see we were assuming. Suppose your company has an asset called A, which has a net realizable value of 90. That asset has a carrying amount of 100. That asset has a value in use of 80. Then I asked you, could this asset have suffered an impairment loss? And if so, by how much? We said, to know whether it has suffered, you compare the carrying amount of that asset, which in our case here, we identified it as 100 million. Then you compare it with the recoverable amount of that asset. And we said, to get the recoverable amount of an asset, you compare two values. One, the net realizable value of that asset. And number two, value in use. Whichever of the two is higher, we say that's what you will pick as your recoverable amount. And from this illustration, the higher of those two was 90. The higher of those two was 90. Once you determine the recoverable amount, and you now have the recurring amount, now you can tell whether the asset has suffered an impairment loss or not. And from this illustration, yes, we saw the condition has been met. The condition has been met. Which condition? That an asset is said to have suffered an impairment loss if the carrying amount of the asset is higher than its recoverable amount. Good. So we saw it has suffered a loss of 10. Good. From there, I gave you another one. I asked you, what if another company has an asset B, which has a value in use of 110, the carrying amount is 140, and the net realizable value is 150. I asked you, could it have suffered an impairment loss? So we had to test again. How? By identifying the carrying amount, which in our question we are given as 140. Good. Then we had to determine what is the recoverable amount. To know the recoverable amount of the asset, we said you compare two values. One, the value in use, and number two, the net realizable value. Whichever of the two is higher is what you pick. And from this case, we picked the higher of the two, and that came to be 150 as our recoverable amount. Then I had to ask myself, when I compare the carrying amount with the recoverable, could our asset have suffered? I have to know the condition. And we said the asset is only said to have suffered if the carrying amount is higher than its recoverable. So we saw from this asset B, our asset has not suffered any impairment loss. Why? Because the condition has not been met. The carrying amount of our asset now is less than the recoverable amount. So you just tell the examiner, no impairment loss. Good. Then from there, I talked about, I can see here, I talked about how do we determine the value in use of an asset. I told you the examiner may give you some cash flows, discount them. How do you discount them? By multiplying those cash flows with the discounting factors, which I told you, you know you have done finance. To get the discounting factors, we said you normally use the formula 1 plus r to the power of negative n. 1 plus r to the power of negative n. R, of course, will be the interest rate that the examiner will give you. Good. Then from there, I gave that. Now, just before I forget, I can see here, listen, I can see here, I gave you an illustration whereby, assuming these were the cash flows, I can see in the 5th year, there is a cash flow of 60. Then I told you some questions, which I have seen in your past papers. Some questions tell you, as per the additional information somewhere down there, you're told in the 5th year, the asset will be disposed and the company will sell the asset for 5 million. So when we shall use the machine in the 5th year, it will generate 60 million. But that is the same year we shall dispose the asset. And in that year, we shall sell the asset for 5 million. So I told you, when you are getting the present value, how much will be the cash flow for the 5th year? Here, I hope you can see it there. For the 5th year, I told you, you don't write there 60. As much as it's true you received a cash inflow of 60, but that is not the true aggregate cash flow, the true net aggregate cash inflow. No, you will receive 60, but then from the additional information as per the question, maybe the question tells you you will receive another 5 as a result of disposal. So you take the 60 plus the 5 you are going to receive. So in that 5th year, you get the present value of an amount of 65 million. That's important. I remember in the year 2022, somewhere they tested that kind of a concept where the examiner gave you a list of the cash flows, and from the additional information, an asset was disposed at the end of the useful life and the company was recovering some amount. So some students could have forgotten and not discount the 5 million which you received at the end of the useful life. Don't forget, we have said it's one of the components of the cash flows that should be discounted. Good. I think that was all. That was all that we discussed. Okay, this is not that much. So what we can do, listen, that time I told you we did not write some summary notes. So let me write the summary notes. So if you want to put down the notes, I think you should put down the notes now. So let's put down the summary notes. Then I do a question. Let's put down the summary notes on what you have already said. We did not write down the summary notes last time. So andika hivi, we are putting down the summary notes now. We are putting down the summary notes. So put down this. So the topic is impairment of assets in bracket IS 36. The topic is impairment of assets, IS number 36. Impairment of assets, IS number 36. Then you say this. An asset is said to have suffered. An asset is said to have suffered an impairment loss. An asset is said to have suffered an impairment loss. An asset is said to have suffered an impairment loss if the carrying amount of the asset, an asset is said to have suffered an impairment loss, comma, if the carrying amount of the asset is higher, than its recoverable amount, If the carrying amount of the asset is higher than its recoverable amount. Another paragraph. Please pardon, I've said an asset is said to have suffered an impairment loss. An asset is said to have suffered an impairment loss if the carrying amount of the asset is higher than its recoverable amount. If the carrying amount of the asset is higher than its recoverable amount. Are you okay so that we continue now? Somebody by the name of EC. Can we continue? Yes, good. Another paragraph. Any impairment loss of an asset, should be written off against the profit. In the profit and loss account. Just say in the profit and loss. Any impairment loss of an asset should be written off against the profit in the profit and loss. Another paragraph. Another paragraph. If a revalued asset, if a revalued asset suffers an impairment loss, if a revalued asset suffers an impairment loss, if a revalued asset suffers an impairment loss, comma, that impairment loss should first be considered as a revaluation decrease. Should first be considered as a revaluation decrease. Should first be considered as a revaluation decrease. i.e. write off any revaluation reserve. Write off any revaluation reserve for that particular asset. Write off any revaluation reserve for that particular asset. Write off any revaluation reserve for that particular asset, comma, and any excess of the impairment loss, and any excess of the impairment loss, and any excess of the impairment loss, and any excess of the impairment loss should be written off against the profit, should be written off against the profit in the profit and loss. Should be written off against the profit in the profit and loss. Should be written off against the profit in the profit and loss. Another paragraph. The carrying amount of an asset, the carrying amount of an asset is the amount at which, the carrying amount of an asset is the amount at which, the carrying amount of an asset is the amount at which the asset appears in the books. The carrying amount of an asset is the amount at which the asset appears in the books of accounts. The carrying amount of an asset is the amount at which the asset appears in the books of accounts. Another paragraph. Recoverable amount of an asset. Recoverable amount of an asset so it is the same as net NPV. Yes, you are right. You are right. The amount at which an asset appears in the books, that means the same as net book value. That's very true. That's very true. Okay, we move on. So I was saying a recoverable amount of an asset. Recoverable amount of an asset is the amount. Recoverable amount of an asset is the amount that is considered to be the higher of. Recoverable amount of an asset is the amount that is considered to be the higher of. Then you put a semicolon. Number one, recoverable amount of an asset is the amount that is considered to be the higher of, number one, net realizable value. Net realizable value. Number one, net realizable value. In bracket, fair value less cost to sell. Fair value less cost to sell. I've said number 1, net realizable value in bracket, fair value less cost to sell. Number 2, value in use. Value in use. Value in use. Another paragraph. The net realizable value of an asset, the net realizable value of an asset is determined. The net realizable value of an asset is determined by subtracting. The net realizable value of an asset is determined by subtracting any cost to sell, by subtracting any cost to sell from the selling price of the asset. From the selling price of the asset. From the selling price of the asset. Another paragraph. Value in use of an asset. Value in use of an asset. Value in use of an asset. Value in use of an asset is the present value. Value in use of an asset is the present value of all the estimated. Is the present value of all the estimated future cash flows. Value in use of an asset is the present value of all the estimated future cash flows that will be generated. Is the present value of all the estimated future cash flows that will be generated from the continuous use of the asset. From the continuous use of the asset. From the continuous use of the asset. Another paragraph. To determine the value in use, of an asset, to determine the value in use of an asset, comma, to determine the value in use of an asset, comma, the following components of the cash flows. The following components of the cash flows should be discounted. The following components of the cash flows should be discounted. The following components of the cash flows should be discounted. The following components of the cash flows should be discounted. Number one, any cash inflow. Number one, any cash inflow. Underline cash inflow. Any cash inflow that is generated. Any cash inflow that is generated from the continuous use of the asset. Any cash inflow that is generated. Any cash inflow that is generated from the continuous use of the asset. Number two, any cash outflow, underline cash outflow, any cash outflow that is necessarily incurred, any cash outflow that is necessarily incurred in order, any cash outflow that is necessarily incurred in order to generate future cash inflows. To generate any future cash inflows. Number 2, I've said any cash outflow that is necessarily incurred in order to generate future cash inflows. Number three, any cash received or paid, underline cash received or paid, any cash received or paid at the end of the useful life of the asset. Any cash received or paid at the end of the useful life of the asset due to the disposal of the asset. 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 Good. So let's do a small illustration here. Let's do a small illustration now. So you can copy this illustration. A small illustration that you just want to put down for the purpose of your notes. Otherwise, we have already explained it. Put down the following illustration. Sema hivi. The following information was extracted. The following information was extracted from the books of XYZ Limited. From the books of XYZ Limited as at 31st December 2024. As at 31st December 2024. Comma, concerning the three assets. Concerning the three assets. So have column A, column A, column B, column C. Then you start with the net realizable value. Net realizable value. Then you come to carrying amount. Then you come to value in use. For asset A, give it 110. These figures are in shillings millions, sorry. These figures are in shillings millions. 110. This is 100. And this is 120. For asset B, make it 125, 150, and 130. For C, make it 100, 120, and 110. Then utaandika required, required, required. Number 1, required, number 1, calculate the recoverable amount of each asset. Number 1, calculate the recoverable amount of each asset. Number 2, determine the impairment loss, if any. Determine the impairment loss, if any, for each asset. Determine the impairment loss, if any, for each asset. Good. So I've already given you a small illustration, so just move faster just for the purpose of your record. That's why we are doing this. Otherwise, you already now know. So we want to determine recoverable amount now. Let's put down the answers now. We are trying to determine the recoverable amount. So you need a column for asset A, B, and C. There is nothing much there. We just identify. Of course, we said recoverable amount is the amount that is considered to be the higher of 1, net realizable value, and 2, value in use. So I'm comparing those two values. Whichever of the two is higher, I pick it. So from asset A, of course, the higher of the two is 120. So put it. That is the recoverable amount. For asset B, again, we compare the net realizable value and the value in use. Whichever of the two is higher, and that looks like 130. Number C, again we compare the two, net realizable value and value in use, whichever of the two is higher. That looks like 110. Good. So now we are able to determine the recoverable amount. Now we want to do part 2 of the question. This is part 1. Finish, we do part 2 now. We want to come and determine impairment loss, determination of impairment loss. Let's determine the impairment loss. Determination of the impairment loss. So maybe again you can have the 3 columns A, B, and C. Already we have discussed how do you determine the impairment loss. Maybe I could put them down here. A, B, and C. To get whether an asset has suffered, we said you compare the carrying amount. So let's identify the carrying amount with the amount we are calling recoverable amount. With the amount we are calling recoverable amount. So let's go back to asset A. How much was the carrying amount? We pick it from the question. And I can see asset A had a carrying amount of 100 up there. It had a carrying amount of 100. We have just identified the recoverable amount as 120. So we need to know whether it has suffered any impairment loss. Of course, you will tell me that it has not suffered. That's very true. I don't want to ask you again because we have already discussed this. We have said the condition has not been met. Our carrying amount is less than the recoverable. We just come and put a dash. Just come and put a dash for asset A, meaning that there is no impairment loss. Good. We look at asset B now. What was the carrying amount? I can see we were given there 150. We have just computed the recoverable amount and we have got it as 130. So we need to ask ourselves whether it has suffered. And of course, the condition has been met in the sense that the carrying amount is higher than the recoverable amount by an amount of 20. So it has suffered an impairment loss of 20. Good. Finally, asset C. What was the carrying amount? We were given the carrying amount as 120. We computed the recoverable amount as 110. So again, it seems the condition has been met in the sense that the carrying amount is higher than the recoverable amount by 10. Good. So for asset number 3, there is an impairment loss of 10. Good. So finish. Finish. If you are through, we can continue. If you are through, you can write there done so that we move on. If you are through with the copying, you can write there done so that I know. You can chat and say done. Good, thank you. Sawa. Now listen. Last time I told you when we were having this topic number 1, when we were discussing it in the last lesson, I told you some examiners don't give you, listen, some examiners don't give you the value in use. Here I was quoting the value in use, but I told you some questions don't give you the value in use. Instead, they give you some cash flows. Okay? Now, I want us to do a simple question, but it was still an old past paper. So allow me to project a question. Allow me to project a question from your past papers. It's an old past paper question. It's an old past paper question. So allow me to project it just to introduce that concept now. I think it was in the year 2000 and something. So it is an old question. I don't think you have it, but I just want to project it. Are you able to see it? I've projected it. Are you able to see it so that I know whether I can read it? Are you able to see it on the screen? You say yes. Yes, good. So let me read it. It was a question that came many years ago, but it's a good question for introduction. It says, number 1, IS number 36. IS number 36. IS number 36 identify, sorry, a minute. IS number 36 identifies, wait, just a minute. IS number 36 requires, IS number 36, sorry, IS number 36 impairment of assets requires firms to periodically carry out impairment review, especially where there is an indication that an asset might be impaired. Then you're told identify 2 internal and 2 external factors that might indicate an asset is impaired. So far we have not done that part. We shall discuss it later. We shall discuss it later. Number 2, or B says, ABC Limited owns a manufacturing plant with a carrying value of 7,490,000. The government has just imposed export quotas on the product manufactured by the plant. Following this development, ABC Limited has prepared the following estimates of the cash flows from the usage of the plant over the next 5 years. So year 1, we project a cash flow of 2.3. The figures are in thousands, 2.3 million. In year 2, we project 2.11. In year 3, we project a cash flow of 1570. Year 4, we project a cash flow of 1040. Year 5, we project a cash flow of 2330. Then the question goes on to say, additional information. Number 1, the plant could currently be sold. The plant could be sold currently for 5.6 million. The selling cost would amount to 100,000. Number 2, cost of capital is 15%. Then you are given the present value factors. You are given a column for 15% and a column for 10.5. Then you are required, number 1, recoverable amount of the plant. Number 2, impairment loss, if any, of the plant. Good. Impairment loss, if any, of the plant. Good. Now, So I was saying part one of the question was a theory part. We have not done that theory part yet. We have not done the theory. I will explain that theory later. But number two, they have given you the cash flows here. You can see those cash flows. They have given you the discounting factor. Of course, the cost of capital under note number 2 is 15%. So this time you did not need to compute. This time you did not need to compute the discounting factors. The examiner gave it to you in column of 15% and 10.5. The 10.5 is just there to confuse you. Otherwise, you use the cost of capital R, which is 15%. Good. So we are told to compute recoverable amount. Of course, I've told you to get the recoverable amount of an asset. What do? You compare two values. One, the net realizable value, and number two, value in use. I told you, how do you get the net realizable value? The net realizable value is given by the selling price of the asset minus any cost to sell. So from note number 1, you can see we are told this plant can be sold for 5.6 million. But for you to realize that 5.6 million, there is a cost you have to incur in the process of selling. And the question tells us under that note number 1 that the cost to sell amounts to 100,000. So we need to determine the net realizable value. That's one. Then from there, we shall compute the value in use. We have been given this estimated future cash flows for the first 5 years. For the 5 years. Then from there, we shall use the 15% as the discounting rate. Then from there, we shall get the value in use. Once we get the value in use, we compare the two, which means the value in use and the net realizable value, whichever is higher, we pick it to become the recoverable amount. Once we have identified the recoverable amount, part 2 of the question said we compute the impairment loss, if any. So what shall we do? We were given the carrying amount somewhere, I remember, as 74 something, 74, what was it? 74.90. So once we compute the recoverable amount, we shall compare now with this value, which is given to us as 74.90. Good. With that idea now, I think you now know what we are saying. Let's put down the workings now. So andika a handout illustration. Just andika to handout illustration. Then andika determination of net realizable value. Determination of net realizable value. So you can see your net realizable value is equals to selling price. Maybe I could put it in full. Selling price minus costs to sell. We were given by note number 1 that the machine or the plant would be sold for 5.6 million. So that is the selling price. 5.6 million. But for you to realize that 5.6 million, you will incur a selling cost of 100,000. So your net realizable, or what you can call the fair value less cost to sell, amounts to 5.5 million. Good. Put down that. Then we do the second determination. So we have now said we now know the net realizable value of the asset to be 5.5 million. Okay, if you are through, you can andika again determination of the value in use. Determination of the value in use. We were given the cash flows, so let's discount them. So you need a column of the year, a column of the cash flows, a column of the discounting factors, and a column of the present values. year 1, year 2, year 3, year 4, and year 5. I want to put my figures in thousands, not in millions, just like the question has given us the figures in thousands. I told you if the examiner does not give you the discounting factors, you can determine them using the formula 1 plus r to the power of negative n. If the examiner does not give you the discounting factors, our r is 15% for this question. Good luck, we were given the discounting factors. So let's quote the cash flows. So let me go back to the question and pick the cash flows. First year it's 23. I'm using the thousands, 21. Second year, 2110. Third year, I'm copying them, 1570. Fourth year, 1040. And the third year, fifth year, 23, 30. Good. So copy those ones. Then we now go and copy the discounting factors they have given us. But otherwise, if they still don't give you, you have to calculate it. So let's go to the question and pick. Maybe we could just do the first one and see whether it will be the same. Our R, don't forget, is 15%. We were given the cost of capital as 15%. So let me just confirm the first one. It is 1.15 to the power of negative 1. 1.15 to the power of negative 1. Just a minute, there's something missing here. If I'm correct, I can see mine is, according to my calculator, 8.8696. Let me see whether it's the same. Let me go back to the question. Yes, you can see down there in the figures they have given us 86.96. So good. Let's copy the others. So copy the others. The second year it's given as 75.61 to be the discounting factor. So copy that 75.61. Third year it is 65.72. Copy it. Third year it's 57.17. Fourth year it is 49.72. Good. Now I can compute the value in use, the present values. So let me compute them. 23 times 86.96. I want to put them to the nearest whole number. So I'm putting mine to the nearest whole number. That comes to 2000. Next one, I'm taking 2110 times 75.61. To the nearest whole number, it looks like 15.95. Third year, 1570 times 65.72. To the nearest whole number, I'm getting 1032. 1032. Fourth year, I take 1040 times 57.17. That gives me 595. to the nearest whole number. Finally, 2330 times 4972. To the nearest whole number, it comes to 1158. 1158. So let me add those values to get what we are calling value in use. So let me add those values. I take 2000 plus 1595 plus 1032 plus 592, no, 95, sorry, plus 1158. I'm getting 6380. Confirm. I'm getting 6380. Somebody's getting 65. Somebody else give us what you are getting. Somebody else is getting 65. Somebody else, what are you getting? Somebody by the name of Patti is getting 63, 65, 33. I don't think he's right, because when I add, unless, even if you never rounded, you use point something, it will not come to that. Thank you. Thank you, Patti. Okay, 6380. Fine. Good. Now let us answer part A. Let us answer part A. Put down like this. Put down this statement below this table. Put down this statement below this table. Comparing. Comparing the net realizable value of the asset. Comparing the net realizable value of the asset, shillings 5.5 million. Comparing the net realizable value of the asset, shillings 5.5 million, with comparing the net realizable value of the asset, shillings 5.5 million, with its value in use. With its value in use, shillings 6,380,000, 6,380,000, comma, the recoverable amount becomes, shilling 6,380,000. The recoverable amount becomes shilling 6,380,000. Good. Now we have answered part A. We have identified the recoverable by comparing the value in use and the net realizable value, whichever of the two is higher. We have picked it to become the recoverable amount. Good. Now we can do part B of the question. Or is it part 2? Whatever they are calling it, is it part 1 or part 2? Part 2. Now let us answer part 2. They are asking us to determine whether the asset has suffered an impairment loss. So that one we just put down something like this. Andika hivi. Andika hivi. We are answering part 2. Comparing the carrying amount of the asset. Comparing the carrying amount of the asset. Shillings. Let me confirm how much it was. We were given an amount of 7 million and something. Comparing the carrying amount of the asset. Shillings 7,490,000. Comparing the carrying amount of the asset. Shillings 7,490,000. with its recoverable amount, comparing the carrying amount of the asset shilling 7,490,000 with its recoverable amount shilling 6,380,000 with its recoverable amount 6,380,000, comma, the asset has suffered an impairment loss. The asset has suffered an impairment loss of the following amount. The asset has suffered an impairment loss of the following amount. So andika hapo chini impairment loss equals to 7,490,000 minus 63,80. So let me calculate it. How much is that loss? 7490 minus 6380 looks like 1,110,000. 1,110,000. Good. So finish. We are through with that question. So finish. I want to introduce a new concept. Finish. I want to introduce a new concept now. Again, if you are through, write down done so that I know. Good. Done. Fine. So let me introduce another concept now before we do another question now. So let me introduce another concept. Okay, so let me introduce another concept now. Listen to this now. As a company, you have an asset. Let's call it asset A. I want to assume that this asset A has a carrying amount of 100 million, or let's say 200 million. You want to know whether your asset has suffered an impairment loss. You have an asset A which has a carrying amount of 200 million, and you want to know whether your asset has suffered an impairment loss or not. So of course you're supposed to calculate what we have called the recoverable amount. Listen, to get the recoverable amount of this asset, we said you compare two values. One, net realizable value, and number two, value in use. Listen to this now. To get the value in use, we have already said, get the present values of the future estimated cash flows. To get the value in use, get the present value of the estimated future cash flows. Now listen to my concern. Suppose this asset A on its own, it cannot generate cash flows. If this asset on its own, it cannot be able to generate cash flows, then it is obviously not possible to determine the value in use. And if you don't have the value in use, then you can't determine the recoverable amount. So So the question is this: what do you do if you are such a company? You have an asset which you want to test whether it has suffered an impairment loss, but the only limitation is on its own, this asset cannot generate its own independent cash flow. And therefore, you cannot test for impairment loss because you can't determine the value in use. What do you do? Let me give you an example. We know of a company called Magadi Soda Company. Magadi Soda Company have their own private railway line. They normally have their own private railway line. They use this railway line to transport the raw material from the lake to the factory. That is the soda ash. Let us assume that this railway line has a carrying amount of 200 million. They want to know whether their railway line has suffered an impairment loss. It is obvious on its own, this railway line does not generate cash inflows. They just use the railway line to transport raw materials from the lake to the factory. But they want to know whether their railway line has suffered any impairment loss. It's an asset to them. So what will that company do? That's the question we want to answer. Okay? Where you realize as a company you have an asset which you want to test whether it has suffered an impairment loss, but the only limitation is that on its own, this asset cannot generate cash flows. So what do? Now, when you have such an asset, I'm not talking of railway line only, it can be any other company having any other asset. What do? Now listen. So what that company will do is this. They will ask themselves, suppose we put asset A in a group of other assets. Let us assume if we put asset A together with another asset, let's call it asset B here, which has a carrying amount of 200 million. If we put these two assets now as a group, listen, as a group, can this group of assets generate their own or its own independent cash flow? Maybe not. You put asset A together with B, you still realize even as a group of two assets, they can't generate their own cash flows. Then you also look at another asset. Let us assume again, suppose we put asset A and B together with another asset, let's call it C, which has a carrying amount of 100 million. Then you ask yourself as a company, these three assets, when I look at them as a group of assets, can they generate, as a group, can they generate cash flows? Maybe this time we realize yes. We realize as a group of these three assets, now this group of assets can generate their own independent cash flows. That group of assets is what we shall be calling a cash generating unit. Is what we shall be calling a cash generating unit. So the point is that if you are a company and you want to test whether your asset A has suffered any impairment loss, but asset A on its own cannot generate its own cash flows, listen, as a company you are required to identify the smallest, listen, you identify the smallest group of assets, whereby if you put asset A in that group of assets, then as a group, they can generate their own independent cash flow. I am not saying put asset A together with all the other assets of the company. No. We are saying put asset A in the smallest group of assets. Look for that smallest group of assets, whereby if you put asset A in that group, then they can generate their own independent cash flows. Once you identify that smallest group of assets, that smallest group of assets is what we call a cash generating unit. Now listen. So you will now determine what is the carrying amount of my cash generating unit. Asset A had a carrying amount of 200, asset B had a carrying amount of 200, asset C had a carrying amount of 100. So the carrying amount of the unit is 500 million. Now that they can generate their own independent cash flows, now calculate the recoverable amount as normal. In other words, compare the net realizable value of that asset with the value in use. Now that they can generate their own independent cash flows, compute the recoverable amount. Listen, suppose you calculate the recoverable amount of this unit and you get it's 350 million. So you will ask yourself, has the unit suffered? Has the unit suffered? The answer is yes. Why? Because we said an asset is said to have suffered an impairment loss if the carrying amount of the asset is higher than its recoverable amount. So from here, we realize that the unit has suffered a loss of how much? 150 million. So now that the unit has suffered a loss of 150 million, listen, then automatically you will conclude that your asset A has suffered. Remember, initially you could not be able to identify whether it has suffered or not. Now that the unit where it belongs has suffered, then automatically even asset A is said to have suffered. Listen to this, another point. Then the question is, how do you allocate this 150,000 or 150 million loss between the assets in the unit? In other words, how do you write off this 150? You have a group of 3 assets, all of them have suffered a loss of 150. How do I know how much asset A will suffer, how much asset B has suffered, how much asset C has suffered? Okay, it's required by the accounting standard that impairment loss of a cash generating unit, listen, should be allocated to the assets in the unit, on the basis of their carrying amount. That means against asset A utasema it had a carrying amount of 200, out of the 500 times the 150, that's how much you write off against asset A. We are getting proportionate write-off. Against asset B, which had again carrying amount of 200, how much do I write off out of the 150? It will be 200 divided by the total of 500 times 150. That's how much asset B will suffer. Against C, it had a carrying amount of 100, divide that by 500, multiply that by 150. That's how you write off the impairment loss of a cash generating unit which has suffered an impairment loss. I have said, listen, I've said that impairment loss should be allocated. The impairment loss should be allocated to the assets in the unit on the basis of their carrying amount. Good. So that's all about A. Now listen. So you now know how to test the impairment loss of a cash generating unit. It's the smallest group of identifiable assets which on its own can generate their own independent cash flows. Then I've said if the unit has suffered an impairment loss, that impairment loss should be allocated to the assets in the unit on the basis of their carrying amount. Good. Now, listen to this now. Listen to this point. Suppose asset C is an asset called goodwill. Suppose this asset C in the unit is an asset called goodwill. So you tested for impairment, you compared the carrying amount 500, you compared it with the recoverable amount 350, You now realize again the unit has suffered 150. Listen to this now. Will you write off this 150 the same way I've written off this 150? The answer is no. Listen to this. The point is that if a cash generating unit to which goodwill belongs suffers an impairment loss, then that impairment loss should be written off in a particular order. This time you don't write off the 150 on the basis of the carrying amount, no, like I did earlier. That is only if you are given a question where the unit has no goodwill. But if one of the assets in the unit is an asset called goodwill, and the unit has suffered an impairment loss, get the point here, then that loss should be written off against the assets in the unit in a particular order. That's important, because some of your questions test you where you are now given a cash generating unit and one of the assets in the unit is an asset called goodwill. Listen. So the first thing you're supposed to do is to write off, out of the 150, write off any carrying amount of the goodwill. You cannot say this unit has suffered a loss and at the same time it has a goodwill. No. It has suffered loss and you know it has goodwill again. No. So they are required by the accounting standard. First write off everything. Listen. First write off everything of the goodwill. Out of the 150 loss, you write off the impairment, you write off the carrying amount of any goodwill. That will leave you with a balance of 50 million being the balance of the impairment loss. Listen, it is that 50 balance now that you write off against the other assets in the unit. Now on the basis of their carrying amount. Remember, we are remaining with two other assets, asset A and B. What was the carrying amount of asset A? 200. What was the carrying amount of asset B? 200. So the remaining assets have a total carrying amount of 400. So this balance of 50, you write off against the other assets in the unit on the basis of their carrying amount. In other words, against A, it will be 200. Divide now by 400, not 500. Divide by 400 because you have already eliminated goodwill. Then you multiply that by 50. Against B, it has a carrying amount of 200. Divide by 400 times 50 again. That's how you write off any impairment loss of a cash generating unit to which goodwill belongs. 1. Write off the carrying amount of any goodwill. Write off the carrying amount of any goodwill. Then any excess of the impairment loss is allocated to the other assets on the basis of their carrying amount. Are we together so far? Somebody say yes. Are we together so far? Because that's now important. We are now going into the main thing now, where some questions may be a bit challenging. Are we together so far? Somebody says yes. Somebody has already said yes. Somebody else? Are we together so far, or you want me to repeat? Make sure you understand this, because when we shall be doing a question now, good. When we shall be doing a question, I hope you will understand. So the first thing we shall be asking ourselves in any question, is there goodwill in that group of assets? Maybe yes, maybe no. If there is, then you know what to do. Good. Fine. So now that you have understood, I've said, let me review before we put down the summary notes on this. I've said, what's the cash generating unit? It is the smallest group of identifiable assets, the smallest group of identifiable assets, which as a group of assets, they can generate their own independent cash flows. I say, why do we form a cash generating unit? Because asset A, which we wanted to know whether it has suffered or not, could not generate its own cash flows. Asset A is the one that brought all these issues. It could not generate its own cash flows. I gave you an example. This railway line, this Magadi Soda company having their own private railway line. They want to know whether their railway line has suffered an impairment loss. But on its own, this railway line cannot generate its own independent cash flows. What did Magadi Soda company do? They identified the smallest group where if they put their railway line in that group, then it will generate cash flows. So they put A together with B and C, they realized it can generate cash flows. Good. Then they tested what is the carrying amount of the unit, what's the recoverable amount of the unit. They realized the unit has suffered, so they decided, let us write off the loss of 150 against the assets on the basis of their carrying amount. Good. From there I went further and said, but what if one of the assets in the unit is an asset called goodwill? Do you still write off the 150 in the same way we have written off? The answer is no. I have said there is no way you can say an asset has suffered a loss and at the same time it has a unit, an asset called goodwill. No. It cannot suffer loss and it has goodwill. No. So I said if a cash generating unit to which goodwill belongs suffers an impairment loss, that impairment loss should be written off in a particular order. 1. Write off the carrying amount of any goodwill. 2. Any excess of the impairment loss should be written off against the other assets in the unit on the basis of their carrying amount. Good. So let's put down the summary notes now as per that. So put down the subtopic. The subtopic is cash generating unit. Put down the subtopic, cash generating unit. Cash generating unit. Then you say this. So we are putting down the summary notes on cash generating units. Then you say this as a basic rule, comma, the recoverable amount of an asset. As a basic rule, the recoverable amount of an asset should be determined for the assets individually. I've said as a basic rule, the recoverable amount of an asset should be determined for the assets individually. Will you stop? However, there may be, or there are, put it that way, however, there are some assets that cannot generate. Their own independent cash flows. However, there are some assets that cannot generate their own independent cash flows. And therefore, it may not be possible. To determine the recoverable amount. And therefore, it may not be possible to determine the recoverable amount of such asset. May not be possible to determine the recoverable amount of such assets. Another paragraph. In order to determine the impairment loss, of such assets, which cannot generate their own independent cash flows, then such assets, or such an asset, put it that way, then such an asset should be put in the smallest, group of identifiable assets, which as a group of assets can generate independent cash flows, Another paragraph. Such a group of assets is called a cash generating unit. Another paragraph. Therefore, a cash generating unit is the smallest. Therefore, a cash generating unit is the smallest group of identifiable assets. Therefore, a cash generating unit is the smallest group of identifiable assets, that can generate its own independent cash flows. Is the smallest group of identifiable assets, that can generate its own independent cash flows. Another paragraph. For instance, Magadi Solar Company has its own private railway line. Which is used has its own private railway line which is used to transport raw materials. That is used to transport raw materials. Let's stop. The railway line on its own, the railway line on its own cannot generate. The railway line on its own cannot generate independent cash flows. Cannot generate independent cash flows. Therefore, the railway line on its own cannot generate independent cash flows. Therefore, a cash generating unit, to which the railway line belongs, should be identified. In which the railway line belongs should be identified. Another paragraph. If a cash generating unit suffers an impairment loss, then that impairment loss should be written off. That impairment loss should be written off. Against the assets in the unit. On the basis. Should be written off against the assets in the unit on the basis of their carrying amount. Underline there, basis of their carrying amount. That's important. I've said then in the impairment loss should be written off against the assets in the unit on the basis of their carrying amount. Another paragraph. If a cash generating unit to which goodwill belongs, suffers an impairment loss, that impairment loss should be written off in a particular order. First write off or eliminate. The carrying amount of any goodwill. Then of any goodwill, first write off or eliminate the carrying amount of any goodwill, then any excess of the impairment loss, should be allocated. Then any excess of the impairment loss should be allocated to the other, assets in the unit, should be allocated to the other assets in the unit on the basis of their carrying amount. Should be allocated to the other assets in the unit on the basis of their carrying amount. Should be allocated to the other assets in the unit on the basis of their carrying amount. Good. Okay. Now, I hope you're okay now. If you are through with the copying or with the writing, andika done. If you are through with the writing, andika done. Done. Thank you. Now, we have no time to do a question now. We should be now in a position to do a question from your past papers now. Of course, I also told you the other one was a past paper, but it was an old question. What we shall do next time, we shall now do a past paper question on a cash generating unit. Okay? That's what we shall do next time. We don't have time to do a question now on a cash generating unit. Okay? But maybe before we close, listen, maybe before you close, and you're here, and maybe you're watching me through YouTube or Zoom classes, and you have not joined our online classes, or you have a friend who wants to join online classes, tell them that we have online classes for the following subjects. One, for the advanced financial reporting, like the one we are doing now. Tell them we have online classes for financial reporting of the intermediate level. Tell them we have financial management. We are offering financial management of the intermediate level and financial accounting of the foundation level and the one of ATD1 and ATD2. So those are the 4 subjects we are offering online classes for as at now. That is advanced financial reporting of the intermediate, financial management of the intermediate level, financial accounting of foundation level, and the one for ATD1 and ATD2. Tell your friends that if they can't join the live classes, then they can still buy the pre-recorded videos for the whole syllabus, and they can watch the videos at their own free time, at their own pace, and whenever they have a question, they can call me anytime. Okay? I will assist. If they want to reach me, they can call me on this number 0722 65 8875 for more information. They can call me on that number. If you need the country code, then it's 254 722 65 8875. If you need the country code, that is 254. Tell them that we have online classes for those 4 subjects. That is advanced financial reporting of the intermediate, financial report management of the intermediate, financial accounting of the foundation level. They either join the live class or buy the pre-recorded videos. Good. Now, some of you are watching me through YouTube. And maybe you have not subscribed to my YouTube channel. Please click that subscription button down there and subscribe to my YouTube channel so that you may be notified whenever we post new videos into the YouTube. Of course, there are some which are there for free, just for promotion. You can even go and watch some of them. They are there on my YouTube channel. Of course, the name of the YouTube channel is CPA Joseph Njuguna. That's the name of the YouTube channel, CPA Joseph Njuguna. If you are watching me through the YouTube and you have not subscribed, please click that subscription button down there. Now, even for you who is watching me through YouTube, and maybe for now you have liked the class At least I hope you have understood something today. Click that like button. Click that like button to like the video. I want to believe even those who are watching through Zoom, they have understood something today. At least you can say, I've gone home with something. Those who are watching through YouTube, click that like button. You can even comment. I have no problem. Comment on how you felt the class was. Good. Okay, for now. Okay. So I want to believe, for those who have not joined the the online classes and you're watching me, please join. Call me on this number 0722 658875 for more details. Okay, good. We accept payments on installments. That's something that can be organized. No problem. So maybe somebody within the group right now, unless you have a comment, I hope you have understood something today. I hope you have understood something today, yes or not. Somebody can give a comment whether the class was okay. Give me a comment. Yes, somebody says yes. Hope you have understood. So somebody can give us a comment. Just chat and give us a comment on how you felt the class was. Hope you have understood. Okay, somebody says well done, step by step. Well understood, sorry. Step by step. That is somebody called MM. Thank you. Thank you. So if you have not joined Mr. MM or Mrs. MM, please join our live classes or buy the videos. Okay. One more comment before I close the class for the next one. Very clear. Thank you. The class was very precise, to the point. Thank you, Pati. Patrick, also very clear. Thank you. Sawa.